Markets have a way of shaking confidence right before the bigger move begins. And if you're watching gold, silver, and crypto right now, wondering whether something just broke, or whether this is just another brutal reset, you're not alone. The key question isn't what prices did in the last 48 hours. It's whether the underlying conditions that drive markets have actually changed. According to Raoul Pal, they haven't. In fact, he argues we're approaching the exact window where liquidity, financial conditions, and the business cycle begin to realign. And when that happens, risk assets don't drift higher. They reprice. In this interview, Pal lays out why he believes crypto could begin accelerating as early as late February 2026, not because of hype or narratives, but because the ISM, financial conditions, and global liquidity are quietly turning. He points to gold and silver not as competition to Bitcoin, but as early messengers, assets that tend to move first when conditions ease, before capital rotates outward. Yes, we've just seen a sharp and violent correction in metals, one that spilled into crypto and rattled sentiment. Many insiders argue this was structural and exchange-driven, not fundamental. And if that's true, then the bigger picture Pal is outlining remains very much intact. So if you've been asking yourself whether this pullback invalidates the bullish case, or whether it's simply clearing the runway, this conversation matters. Stick with us as Pal breaks down liquidity, the dollar, gold, Bitcoin, and whether 2026 could still deliver the kind of crypto cycle most investors are positioned too early for. If this analysis helps you think more clearly about what's coming, tap the like button, subscribe for more macro-driven crypto breakdowns, and let me know in the comments. Do you think this move shook people out or woke them up?
Are you still bullish now on Q1? And when do you think we could see those liquidity dynamics reasonably shifting?
So, yes, I'm still very bullish on Q1. And it's going to be a big test of my hypothesis that the liquidity conditions are coming over this Q1 period. But, we've seen the changes to the bank regulations, the ESLR, which means that the Treasury can directly monetize debt by selling it to the banks. That increases liquidity in the overall system. We've got a potential partial shutdown of the government still to get out of the way. So we've got that. But so they haven't been drawing down the TGA, the Treasury General Account, but that's likely to start happening as well. We're likely to start to see signals about the change of who's going to be the Fed chairman. And, if you see Rick Reeder, he's talking about interest rates are 100 basis points too high. So we've got a lot of liquidity conditions along with fiscal stimulus all coming in Q1. Because don't forget, the game here is for the Republicans to win the midterms. And they're going to try and juice the economy as much as possible. So we should see the ISM, the business cycle, starting to rise as well. So from everything I look at, it suggests that liquidity is coming into the system. The main liquidity source currently is the Chinese. So they've been using their balance sheet. Liquidity is starting to expand. The weaker dollar is one of the biggest indicators of liquidity as well. So for me, it's all here. It's just a matter of waiting for a catalyst of which to take this all off. Because I think the market is currently trading at a discount to liquidity conditions and at a reasonably significant discount. So, if you were to close the gap versus liquidity, Bitcoin should be where we are today. We're around 90,000 as ever, doesn't move. It should be sort of 140,000. So there is a reasonable difference. Yeah.
Okay.
So there's a reasonable difference and some alligator jaws to close. So we use financial conditions, which leads by 9 months, ISM. Then 3 months behind that is global liquidity. And eventually you get to ISM. So we use probably, several hundred forward-looking forecasting indicators for ISM. And they're all suggesting ISM comes strong this year. Then we can double check that against what Scott Bessent's saying. And Scott Bessent is saying, we really need to stimulate Main Street, not Wall Street. And stimulating Main Street is about bringing lending back and confidence back. So fiscal stimulus helps. It gives people more money to spend. They've got huge kind of tax depreciations on fixed asset investment. Remember, we've got this massive CapEx boom to come. We're going to be building data centers and power generation across the United States. So that's going to generate jobs. They're going to try and get mortgage rates lower, which generates more free income for people to invest, take risk, do these things. These tend to increase the ISM survey. Additionally, the changes to the ESLR means that banks are free to lend more, so they can use more leverage on their government bonds. So that lending has been restricted really to Main Street companies. It's not been easy to borrow money. So that allows for the free flowing of money. So you've got a number of factors that all suggest that the business cycle should pick up. And again, Scott Bessent's telling you they want to close the gap of the K-shaped economy. What is the K-shaped economy? It's markets versus the ISM. And what we've seen is technology and even crypto, if you take it back, have outperformed while the economy has been extraordinarily flat. So if they're going to win an election, don't forget the Trump base is middle America, the disenfranchised middle American. And if they want to get voted back in, they're going to have to prove they've done something. So I think it's all set up for this to be very strong for the ISM. So what happened was the liquidation cascade starts, there's forced deleveraging, but then the Binance API went down for the market makers. That couldn't have been a worst possible outcome. Now, let's assume it just happened because everything was breaking at the time. No market maker was able to bid in these liquidation cascades. So they became much more exacerbated. So who then bought, because we couldn't as retail get onto the platforms either. We were pretty much shut out of everything. There was this whole discrepancy between Coinbase and Binance. So who stepped in to provide the liquidity? Sure, the market makers came back. They got some, but we know they got slightly impaired because everything shut down. They couldn't trade. And my guess is the exchanges, because it happened on a few Asian exchanges as well, probably had to use their balance sheet to step in to provide liquidity. Because if they hadn't, it would have broken everything. Everything would have kind of gone to zero. So it would make sense to me that occurred. And nothing nefarious. It's like, what the fuck do? We need to do something about this. We need to provide liquidity. So you use your balance sheet and you buy whatever's being liquidated. So then you've bought a whole bunch of altcoins, Bitcoin, everything. I don't know how much, let's say the number's 10 billion. Who the hell knows, right? Now you need to get rid of that off your inventory because you can't hold it on your balance sheet. They're not a hedge fund. So then you've got to work it out. So how do you work it out? Well, you kind of do it like you did in program trading and equities, is you work it over time, which would explain why we got these weird, as soon as the US opened, 10 o'clock, the most liquid time of all of crypto, the slam. Because somebody uses an algorithm, what's the most liquidity? That's that time of day. How much do we need to get out of? Let's say it's, X, 200 million a day, whatever the number is, and you get the slam. And that had the footprint of that. We didn't see any other evidence on chain of others doing stuff. So it kind of made sense to me. And I think that created the liquidity gap the other markets didn't show.
What makes Pal's framework compelling isn't just that it's bullish, it's that it explains why markets can look wrong before they snap back into alignment. Liquidity doesn't announce itself. It seeps in quietly through fiscal channels, balance sheets, and currency moves long before price reflects it. That's why moments of stress, flash crashes, forced liquidations, sudden breakdowns often appear right before broader participation returns. We've heard similar thinking from macro voices like Julian Biddle and Andreas Steno, who've also emphasized that financial conditions lead price, not the other way around. And that sets up the next question Pal tackles next. If gold and financial conditions move first, where exactly does Bitcoin and crypto more broadly sit in that sequence? And that's where the real rotation story begins.
So there's something called what we call the everything code dominoes. It's what drives what assets and when. And it's all phasing. So gold, financial conditions leads everything by about 9 months. Gold perfectly reflects financial conditions, as does dollar yen, as does silver. They're all in financial conditions land. So it's in the future. So they lead Bitcoin. And you can put the chart against it very nicely. And there's a very clear lead lag between gold and Bitcoin because Bitcoin lives in somewhere around liquidity, global liquidity. Global liquidity leads it a bit by 3 months. So what you've got is a phasing. So when we talk about a rotation, it happens naturally. Like we're now seeing as the business cycle picks up, what happens when the business cycle picks up? Commodities go up. What's happening right now? Commodities are signaling the business cycle is going to go up. That phasing is always prevalent in markets. It's always there. So when I see gold doing what it's doing, it's telling you financial conditions are easing massively. The biggest driver of financial conditions is the US dollar. The US dollar got absolutely murdered the last few days. We still expect it to go lower. That increases financial conditions. It tells us the length of the cycle because it lives 9 months further ahead than here. So it's like, well, the liquidity cycle can continue towards the end of next year now, September of next year. Everything seems to be playing out as it should be playing out. I don't know if you remember in 2020 over the pandemic, gold went first. I remember because I was buying gold and then ended up just switching everything into Bitcoin because Bitcoin becomes an outperforming asset because, gold can do a couple of 100%, crypto can do 5, 10x if you're lucky. So again, it's the patience thing. It's right. You've got the financial conditions that are showing us that liquidity is going to pick up. We've got gold confirming that. And now we're just waiting for crypto to do it. And we've seen NASDAQ following liquidity all the way perfectly. So I don't think there's anything wrong. I think we had a temporary aberration because of what happened in 1010 in crypto. And that will clear out the way and we'll have forgotten all about it in 6 months' time. I think gold can still go further. I don't think it's clearly overdone, but I think it can go further. Can it go sideways for a month or two, ease off a bit of the overbought because the RSI is like 97 or something stupid. But I still think it goes further because I think the dollar goes lower. And I think financial conditions have to be very easy to deal with the debt rollover and the interest payments on the debt. And gold follows that chart perfectly as well. Again, there's a whole kind of flow of how this all fits. So yes, I think it goes further. Silver, don't know, possibly. But, we're obviously wildly overbought now. Generally speaking, it should go on a little bit longer, whether it's another 2 or 3 months. So at a top level, yes, central banks want to be less reliant on dollar assets, but not massively so because they all need dollars. 87% of the world trade is in dollars. Over 50% of world debt is in dollars. So the dollar ain't going away. There's nothing they can do about it. They can't do it. If the Saudis want to hold less dollars, it's difficult because they get paid in oil in dollars, and they're huge investors. So what happens every time is when you're at this point in the cycle is the dollar weakens. It's driven by the business cycle.
Do you think we're still going to see this massive all-in altcoin rally that we've seen in the past? Do you think that alts still have chance this year? What's your view on that?
Yes, I do. It's all about the risk curve. All assets are priced according to a risk curve. The least risky asset is Bitcoin. The most risky is a meme coin. So what happens is when Bitcoin goes down and liquidity is withdrawn, the most risky assets fall. What happened after liquidity was withdrawn from the US because of the rebuilding of the TGA and the government shutdown? The riskiest asset, Bitcoin, fell. NASDAQ didn't really. So it always happens the same way. It happens in the credit markets with treasuries and emerging market junk bonds. It's always the same process. So if Bitcoin falls 30%, ETH's going to fall 40, Solana's going to fall 65, Sui's going to fall 70, and meme coins are going to fall 95. That's normal. It's just a normal risk curve. And so it's not about a lack of demand. It's about a lack of risk taking due to liquidity conditions and disposable income. So then let's play forward to what we talked about at the very beginning. What do we expect this year? The business cycle to rise. What does the business cycle do? It gives us all more money in our pockets, more confidence in the economy, more risk taking. So when you put the ETH Bitcoin cross against the ISM, it's the same thing. It's all the same thing. It's all the business cycle. And so when the business cycle picks up, people go out the risk curve. So what alts you own? Okay, that's the hard thing. That has always been the hard thing in alts, right? It's not, people think alt season and think it's your God-given right that your bag will go up, but that's not how it works. Particularly the more and more tokens there are, a whole bunch of this stuff is uninvestable, will never get investment. So you have to ask yourself, is there provable network adoption and attention? And those things give you a higher quality trade than, hey, XYZ thing is down 95%. It looks cheap. Is that going to work? To a certain extent, yes, because the liquidity flows through the market making. And what happens is it tends to readjust prices on a relative basis. But the best thing is just to think carefully about what you're buying. If you want to do alt season sensibly, you're pretty easy to buy Ethereum and Solana. It's not that difficult. Same trade.
Exactly. You don't have to necessarily go down the risk curve. You can just invest in the most established networks with the most network effect.
Maybe you put 50% of your capital in Solana and ETH. Then you've got 50%, you can go a bit further out the risk curve. So let's say some of the layer ones that are interesting and maybe some applications layers. and then a couple of your pet projects that might do really well in AI or whatever, right? That'll give you a relatively balanced portfolio where you can't fuck it up. Because if not, everybody f it up.
And then in terms of particular narratives that gain mindshare, you've talked about AI, of course, as it relates to the AI trade, but any other crypto narratives or niches that you think could be interesting apart from the L1 and AI trade?
It tends to rotate anyway. And I don't like the narrative trade. It's too hard. It's too hard because capital is super fast in crypto. And by the time you hear about the narrative trade, everyone's moving on to the next one. So I'm very cautious of following narratives. My basic thesis is, will we use more block space in the future? What kind of block space do we need? And then even the applications layer is difficult to do. Hyperliquid now might seem the best thing in the world. Where does it stand in 3 years' time? I don't know. It feels more difficult to me than saying, will a layer one that is quality and has proven itself end up with more usage over time? I try and avoid all of the narrative stuff and just really zoom out and say what is likely to survive. So let's talk about BitTensor, which I don't have a investment in, although I keep looking at it. There is some traction within it of what's happening. People are using it. The narrative feels right. It feels directionally right. Is it going to be the one? I have no idea. It's not. These aren't easy. Zcash, another great one. Privacy. It's a very clear, clean, memetic understanding. It probably does decently well, and other privacy solutions. But then we'll see other blockchains introducing privacy solutions of different ways. So maybe it becomes less of an issue. But also, those of us who have been around crypto long enough, I'm not sure I want to fight with the bloody governments all over again.
Before we wrap this up, it's important to confront what just happened in markets, because on the surface, it looks chaotic. Gold and silver, which had been leading this cycle higher, suddenly suffered a violent collapse. That shock didn't stay contained. It spilled straight into crypto, and ironically, crypto took some of the worst damage, despite the fact that it never fully participated in the metals-led rally to begin with. For a lot of you watching this, that probably felt deeply unfair. And frankly, that reaction makes sense. But this kind of dislocation is often what happens when positioning, leverage, and uncertainty collide all at once. Zooming in on silver helps explain the mechanics. Silver had reached historically extreme momentum levels, with monthly RSI readings that have only appeared a handful of times in modern history. In past cycles, those conditions didn't resolve gently, they reset aggressively. What makes this episode more complex is the growing divergence between paper and physical markets. Prices in paper-heavy venues collapsed, while physical markets, particularly in Asia, continued to signal tight supply and elevated demand. That disconnect doesn't invalidate silver's long-term role, but it does explain why the correction was so sharp, so fast, and so destabilizing across risk assets. Then came the catalyst that markets were not prepared for. The sell-off accelerated as probability surged that Kevin Warsh could become the next Federal Reserve Chair, and markets know exactly what that implies. The fear isn't rate cuts. It's rate cuts without open-ended balance sheet expansion. That's a problem for highly leveraged trades, stretched equity valuations, and liquidity-dependent rallies. In short, markets are suddenly being forced to price a world where easing is no longer automatic. And just as confidence was already fragile, another layer of uncertainty dropped. The U.S. government officially entered a partial shutdown after Congress failed to meet the funding deadline. That matters more than most headlines suggest. Shutdowns freeze parts of fiscal flow, disrupt treasury operations, and complicate liquidity expectations, especially at a moment when markets are already hypersensitive to anything that threatens cash flow or confidence. It's not that the system breaks overnight. It's that risk tolerance evaporates when too many unknowns stack up at once. Put all of this together, and what you're really seeing isn't a broken thesis. It's a stress test, a rapid unwind driven by leverage, policy uncertainty, and political dysfunction. Raoul Pal's broader argument still hinges on financial conditions, liquidity, and the business cycle, and none of those resolve cleanly in moments like this. But historically, these are the kinds of episodes that clear excess, reset expectations, and ultimately determine who's positioned for what comes next. If you made it this far, I appreciate you spending your time here. If this breakdown helped you see the bigger picture more clearly, hit like, subscribe for more deep macro crypto analysis, stay sharp, and I'll see you in the next one.